Hello and welcome back. It's so great to be with you again. For those of you who are new here, my name is Sansere Govere. I'm the owner of Online Accounting Tutor, or OAT for short. We create quick, easy, and engaging content to help you master accounting. Today, we are moving forward from where we left off in part one. If you haven't had the chance to review part one, go and do that first, and then come on back. In this video, we will focus on debits and credits for equity accounts, specifically retained earnings. Ready, set, go. Let's review a key concept that we learned in part one. If you know that debit increases asset accounts, then you have the key to the kingdom, my friend. And when you cross that bridge to the other side, you will just do the opposite. Liabilities will increase with a credit and equity will increase with a credit. Knock, knock, knock. Is anyone home? We are now visiting the house of equity. Equity is like a haunted house or a fun house, if you prefer, because it has hidden doors. There are doors within doors. My goodness. Let's go ahead and take a peek. Go ahead and open the door to retained earnings. Let's see what's inside. You have now entered the room of retained earnings, and there are 3 more doors. We have revenue, expenses, and dividends. Oh my, it sounded like I needed to say that there. If this is confusing for you, don't worry. Hold my hand and I'm going to guide you through this haunted house. I've been here so many times as an MBA student, as an undergrad, and as a financial analyst. Trust me, I got your back. Now, let me give you a very important tip though. Accounting is the language of business. And when you study another language like Spanish or French, you have to learn the words, okay? Flashcards are a great tool to study vocabulary. Also, take advantage of my free accounting glossary. You can find it on the OAT website. The URL is provided in the description of this video. Here is another perspective to show you the hidden doors of retained earnings. Retained earnings is like a bank vault inside of that house of equity. Retained earnings is where we store the profit made from past periods. If it helps, you can think of retained earnings as like a really big piggy bank. Every accounting period, okay, we are adding our extra money into the vault for safekeeping. That extra money comes from revenue minus expenses. It's what's left over from the money the company earns after it pays all the bills. We call that extra money net income. There are some cases, though, when your revenue is smaller than your bills. In that case, when you do the math, you will end up with a negative number, and this is called a net loss. For example, if the business makes $1,000 in revenue and total expenses are $1,500, you are in a hole, my friend, for minus $500. We call that the net loss. If your company is at a loss, you will pull money from retained earnings to cover it. In other words, losses decrease the total balance of retained earnings. Also, sometimes we take money out of the vault to pay stockholders. We call this payment dividends. Again, whenever we take money out of that vault, it decreases the total balance of retained earnings. Is this making sense? I hope so. If not, it will make sense once we apply what we've learned to a problem. Make sure to lock the vault on your way out. Let's go. Ready for some questions to test your learning? I know you'll do great. Okay, question number 1. A firm has a positive net income for the period. Does this increase or decrease retained earnings? Is money going in the vault or is money leaving the vault? Question number 2. Revenue is $100,000 and expenses are $110,000. What is the net effect? How does this impact retained earnings? Is money going in the vault or is money leaving the vault? On to the last question, number 3. The company performed very well this period, so it decided to pay stockholders a dividend. How does this impact retained earnings? Is money going in the vault or is money leaving the vault? Here are the answers to the 3 questions. If you got something wrong, drop a comment below and I will help you. Okay, folks, I have one more bonus question, and this one is worth 100 points. The pressure is on. If expenses and dividends decrease retained earnings, what is their normal balance? A debit or a credit? If you guessed debits, then you, my friend, are the accounting master of the day. 100 points goes to you. If you got this question wrong, don't even sweat it. You know I got your back. On the next slide, I give you a special tool that will ensure success every single time. Use the acronym DEALER. This will ensure that you get every question correct. Dividends, expenses, and assets increase with a debit, and liabilities, equity, and revenue increase with a credit. Now, let's apply everything that we have learned from part 1 and 2 to a problem. ABC Company sells inventory for $50,000 on credit. The book value of the inventory, or the original cost the business paid to acquire it, was $20,000. The first step to tackle this problem is to identify the accounts that are impacted. I'll give you a hint. When you sell inventory, there are 4 accounts that get hit. The answer to step number 1 is, first, accounts receivable, because the customer bought the inventory on credit. Accounts receivable is like an IOU to the business. The customer gets the product today in their hands and agrees to pay for it at a later date. An easy way to remember this is the word receivables. The company will receive the cash later. Next, revenue. Accounting principles state that revenue is recognized when it is earned. That means so long as the company delivers the product to the customer, it can record the revenue on the books. In this problem, the customer has not paid. Again, accounts receivable is an IOU from the customer. Even though the business did not get paid, it will still recognize the revenue because the company has completed its job, right? The product has been given to the customer. The third account on the list is inventory. The company sold its inventory. That means its total balance of inventory will decrease. Cost of goods sold refers to the book value of the inventory. In other words, this is what the business paid to make or acquire that inventory. Accounting principles state that revenues and their matching expenses must be recorded at the same time. It's called the matching principle. Okay, this means when we recognize the revenue, we must also recognize the expenses incurred to generate that revenue. Revenues and their expenses are handcuffed together, so you have to record them at the same time. Great job. Now it is time to assign the normal balances for each account by adding the plus and the minus signs. Accounts receivable and inventory are both assets. Therefore, they increase with a debit. We know that revenue increases retained earnings. Therefore, its normal balance is a credit. We also know that expenses like cost of goods sold decrease retained earnings. Therefore, its normal balance will be a debit. If this is confusing to you, just go back to slides 11 through 13. Now it's time to add our numbers. There it is. Accounts receivable increases by $50,000. Its counterpart, revenue, also increases by $50,000. Remember, we are recognizing that revenue earned since the product is in the customer's hand. Also, revenue is going to increase the total balance of retained earnings and thus equity. Next, inventory decreases by $20,000. That's a credit to the account. And finally, its counterpart, cost of goods sold. We will debit this account. This debit is tied to retained earnings and thus reduces the overall balance of retained earnings and equity. Done. You have come such a long way, and you should be so proud of yourself. These are really complex topics that you're grasping, and all your hard work is going to pay off. Again, my name is Sansa Ray. I'm the owner of Online Accounting Tutor. If you need one-to-one tutoring support, I am here for you. You never have to struggle alone. And if this video was helpful, make sure to share it with your classmates because they shouldn't have to struggle either. All right, folks, until next time, see you later.